Hey, let's talk segment 2 here, Unit 4 futures markets. And let's get to some examples here and how we would actually apply this futures markets trading concept that we've been talking about here briefly. First things first, when we talk hedging and some key concepts here to think about, it's again the process of shifting risk from the cash market to the futures market. And again, trying to augment or enhance that price that you're going to get in the cash market. You know, you're going to simultaneously hold an opposite position in the cash and futures markets. So most of us that are long the futures, long in the cash market, like we have a crop growing in the field, it may be wise to be short the market in futures so that you're in the opposite position. Now, if you're going to go trading and you have that brokerage house relationship that we referred to in segment 1, you're going to have to put some money into a bank account, so to speak, and to guarantee performance of some kind, and for that brokerage house to draw on and then deposit to whenever you make and lose money. And you have to maintain a minimum balance in there, and that's called margin money. That's really, really important that you have that available and able to utilize for trading. Second, that's the amount by which all of your positions are not be allowed to fall below. So it prevents you from doing anything illegal and any bankrupt activity, hopefully, for protection. So when we talk about taking out a short hedge, you're basically selling futures. A long hedge would be buying futures. So those are kind of the relationships and some of the terminology that we want to refer to. You know, again, we're going to try and minimize risk here. So generally speaking, cash and futures are going to typically move in a very similar direction. It's very, very rare that you would see a futures rally in the marketplace and a depressed local price going the opposite direction. Almost always, they're going to follow similarly up or down. And they may not be exactly the same movement depending upon local supply and local demand, but they're oftentimes going to move in the same direction. So again, when we talk about trading on the futures market, an actual commodity is not going to change hands. That speculator that's going to buy 50 contracts of corn because they believe that the price of corn is going to go up dramatically in the next few days, they're never going to accept a semi-load of corn. They're going to sell that contract and get out before anything would have to be taken care of in terms of a physical delivery. So they're essentially trading paper. You're basically doing the same thing as you're taking a futures contract position, long or short, and you're going to opposite that position before any grain would have to be delivered to meet that contract demand. So you're going to basically do that. So from a cash exchange perspective, a loss in the cash market hopefully is going to be offset by a gain in the futures market. And we'll go through some examples here in a little bit. So who can hedge? Well, we've already mentioned that farmers are definitely ones that are going to hedge. They're going to try and protect themselves against declining prices. An elevator operator is absolutely going to hedge. They're going to hedge a lot of the grain that comes through their storage facilities to protect against changing prices one way or the other. Processors, absolutely. If you think the soybean processing plant, major one at ADM in Decatur, Illinois, doesn't hedge a lot, you'd be mistaken, because they hedge against price rises very actively and employ a whole division of traders in order to help buy soybeans as cheap as they can that go through their crushing plant to make soybean meal and the various other products that they make. Exporters absolutely are going to seek protection in the cost of commodities that they've not yet acquired. So they're absolutely going to hedge, because everybody's trying to either buy or sell their commodity at the cheapest input price that they can get it, or the maximum price that they can get for it. So how do you plan the perfect hedge? How do you evaluate this position here? Well, first things first is we're going to make a T account. The next slide is going to show you kind of how that works. For this part, let's not worry about commission fees, account commission fees. We'll just kind of leave that to the side for a second and simplify it. And we're also going to ignore basis for the moment. Just to, again, kind of keep this as simple as possible. We're going to try and lock in a high price to sell corn, and we're going to assume prices fall at harvest. So let's see if this hedge works out for us here. So first things first, we'll start at the top left-hand side here. And we always say we want to put a target price together. So let's assume for a moment that it's July. We'd like to target $4.50 a bushel for corn. That's our wish. We would have done already some mathematics to know that that's hopefully well above our cost of production. And so we say that's our target, July time. We're following the markets. And so we see that there's maybe an opportunity. So we sell a 5,000 bushel futures contract at $4.75. We see a good rally in the market, and we see that that's a really nice position to take. So we're going to go ahead and sell just one contract at 5,000 bushels for $4.75. Harvest time comes along, and we deliver corn to the elevator. Yields are good. Price drops, as it oftentimes does around harvest time, to $4.25. So we sell that across the scale for that $4.25 price. Remember, on the futures market side, we took that short position. That means we've got to offset it because we had that, let's say, harvest delivery or September contract. We've got to buy that 5,000 bushel futures contract position out at $4.50. So let's see how we made out here. Well, if you subtract $4.75 from $4.50, we made 25 cents in the futures market here. Okay, we sold it at $4.75. We bought it back at $4.50. We made 25 cents. We take that quarter and we add it to what we got for corn across the scale at $4.25. And so we netted $4.75 a bushel for our corn, which was, I have a typo here, $4.50 for our corn in the future in net. So we did really well, and we met our target price despite the typo here. Let's do another example on soybeans. So let's say we targeted a price of $10 a bushel for soybeans. August rolls around, we're kind of trying to book some soybeans and protect some price. And we go out there and we go long. We think the market's going to go up and buy a futures contract at $9.50 a bushel on those 5,000 bushels in August. Harvest time comes a month and a half later, and we have a semi-load of soybeans. We sell them across the scale. $9.75 is our harvest price. And we have to close that long position that we took. And so we sell that 5,000 bushel futures contract for $9. Now, if we follow along here, obviously we didn't do so hot. Okay, we went long at $9.50. We bought. We have to sell it at $9, so we actually lost 50 cents on our futures contract. We sold cash soybeans across the scale for $9.75. We have to actually subtract that 50 cents that we lost in the futures, so we netted $9.25. Clearly, we were 75 cents shy of our target price, and this is a good example of what occasionally can happen when you play futures contracts. So, what else affects final price? Again, I mentioned that we weren't taking into account basis, and we're going to have a few slides that explain basis here for a second. Also, you need to know about interest rates because you need to know how much time value of money has an important role in this. You want to be able to know whether that's a good place to invest your money. We need to know how much commission we can afford to take on trade contracts, and what does it cost to store it if we have to put grain in storage, either at home or at the elevator. Furthermore, so let's look at basis. Cash price minus futures. We've been calculating that kind of all along the semester here, kind of keeping track of that difference, so to speak, between the local price and the futures price. And it always varies by location. And much of that depends upon, your proximity to an elevator and how much grain is supplied locally. And so it's determined by transportation, availability of that transportation, storage, interest rates, price expectations, and so forth. One of the things that you maybe don't think about is that, well, everybody's got a semi or a truck or a wagon and can get it to the marketplace. True. But that elevator has to also transport it somewhere. And of course, we know in the Midwest, most of our grain either gets on a train and goes somewhere to maybe the Southwest in Texas where there's lots of cattle to feed, or it most likely gets on a barge and goes to New Orleans to catch a ship ride to a foreign country for export. One of the things that we rarely think about is what's going on at the river that maybe creates bottlenecks, whether that's slow movement up and down the river due to just barges can't get through the lock and dams efficiently, low water conditions, whenever there's a drought and there's not much water in the Mississippi, that creates channel problems, and therefore tugs can't get up and down the river with barges. High water conditions can cause the same problem because you tend to have a lot of debris floating and it's not safe for them to move. That creates a challenge occasionally, as does ice. In the wintertime, if you get a lot of ice accumulation flowing down the river, it's not safe for the barge traffic. So you can have a bottleneck there that oftentimes we don't even think about, which starts to create basis problems for us. So that's why we say availability of transportation is really critical. Kind of adding to that, how do they determine local basis? Again, how do they figure out what that basis spread difference is? And so you can figure this out most of the time using a spreadsheet, very much like the one I have you practicing in class. Is prices may be different greatly from year to year. You may see, this year we're going to look at probably a harvest price, maybe in that $9.50 range for soybeans and probably about $3.30 or so for corn. But next year it might be $4, and the next year after that it might be $5. But I guarantee you the basis is going to be very similar. It might be 25 cents under the board at harvest time, or 10 cents under the board at harvest time. And then by December, depending on how much grain is there, it might be 15 cents under the board. And if you have a slug of grain, it might be 40 cents under the board. So basis spreads generally are very consistent seasonally. So if you kind of know what typical basis spreads are, it can give you a very good clue on when to sell, irregardless of what the price is. So make sure that you follow that very, very closely, because basis spreads is really a great indicator of what's going on. A little bit on terminology, and we talk about here, give you some examples. If local price is $6.45, December futures is $6.35 for corn, and boy, wouldn't those corn prices be nice today? We would call that 10 cents over the board. More likely for us, a local price of $6.14, futures trading at 6 1/4, 9 cents under the board. We're most of the time in Southern Illinois going to be under the board. Same thing, more terminology. A weakening basis means the cash price is getting closer to the futures. And depending upon the time and supply demand and how much grain they're trying to attract into the marketplace, maybe how much they anticipate for a harvest crop, you may see a weakening basis where that local price gets a little closer to futures, and eventually maybe even an inverted market. A strengthening basis occurs when the cash price goes the opposite direction, and you see a wider spread away from the futures price. So you'll call that also narrowing, same as weakening, or widening, the same as strengthening. I mention those because occasionally you'll hear market analysts talk in one way or another and use some of that different lingo, that it's nice to know what the heck they're talking about whenever you're trying to listen to an expert, help guide you and give you some advice. So same thing, if you're long the market, you'd like for that basis to weaken or narrow. If you are in a buy position or long the market, like we are oftentimes with crop in the field. If you're short the market, you'd like the basis to strengthen or widen. So that way you're probably going to be in a more profitable position. So a few things on successful hedging. We've kind of talked about these, but we'll reinforce them here before we just about wrap up here with this particular segment too, is always keep the size of the futures position no larger than the size of the cash grain position you could produce or deliver. Don't get outside the bounds of what you can normally produce. So if 50,000 bushels of corn is all you can make, don't trade any more than that because you'll get yourself in trouble. Close those cash and futures positions at the same time. Make sure that you can meet those futures contract demands. And then when making hedging decisions, make sure that you've got good people on your team. A good, knowledgeable, and reputable broker is definitely worth the commission that they charge you. So some take-home messages as we finish out segment 2 here is, we know that trading futures can enhance on-farm profitability. It's a key piece of the puzzle, like I have here on the screen, to provide you some extra cash. And if you can figure out how to fit this into your marketing scheme, you'll definitely have the opportunity to add some profitability. Make sure that you're paying attention to shifts in supply-demand relationships. Listen to people that you think are wise readers of the marketplace. They'll help you kind of read what's going on in the market. Always keep track of local basis trends. Know seasonally what those typically would be at your favorite local elevator. And then hedging on basis, like we said, is generally more informative than price hedges. I can give you an example. I'd love to sell beans at $11, for example, in today's marketplace. That would be a wonderful price to sell at. But if that $11 was 50 cents under the board, well, then my local elevator is telling me, hey, don't bring me any beans. I'll buy them, but they'll be at a discount. Whereas even at, let's say, $9.50 beans, if the local price is $9.45 and I'm just a nickel under the board, my elevator is really trying to get me to bring beans to the elevator because they're getting short, and so they'll only they're trying to get you to bring them there, and if nobody will deliver, they'll come closer. They'll weaken that basis even more and get closer or even inverted to try and get producers to bring them grain. So understanding that basis spread difference is oftentimes more important than just reading the total price. So hopefully those 2 lecture segments help describe how to put futures contract strategies into play. We'll be practicing them in class. Hopefully it will help you in the commodity challenge that's ongoing, and hopefully you'll find that there's some real profitability options here if you can employ this in your trading scheme. Thanks for listening to this segment.